Hi, this is Mike, and tonight we're going to talk about restoring the dream of prosperity and financial independence. We're going to talk about earning more money, protecting your assets, and securing your financial future. Before we get there, though, let's go over a quick disclosure document. Understand we're going to be talking about specific investments and income statements and things like that. And all of these are just for illustrative purposes. Understand there's no guarantee that you're going to make money or that your products are going to perform the way that these are going to perform. We will provide specific illustrations for your specific situation if you request them. So understand that anything I'm doing tonight is just for education purposes. So let's take a look at where things stand today. Where are things? Are you providing for your family the way that you want to be providing for your family? Are you able to give to charities, helping other people the way you want to be doing that? Is your retirement on track? Are you secure in where things are going to go? Let me ask also, are you better off today than you were 5 years ago or even 10 years ago? If not, it's time for us to make a change. I like this quote by Tony Robbins. Stay committed to your decisions. You made a decision a long time ago that you're going to be successful, that you're going to be able to fund your retirement. But now it's time to stay flexible in the approach that you've been pursuing. It's time for you to do something a little bit differently so that you can move forward from where you're at today. So QS2 is a financial services marketing company. That's what we're about. We're about showing people how to take financial services and change their financial lives. And why financial services? Well, right now, 68 million Americans have no life insurance at all. In fact, only 35% of the population has insurance. That's the equivalent, those without insurance would be the equivalent of every man, woman, and child in the green-colored states on this slide. That's a lot of people that need coverage. Also, it's estimated that $30 to $40 trillion are going to transfer from one generation to the next over the next 15 years. That's that baby boomers starting to move forward and passing on and leaving that money to the next generation. The average age of a life agent is over 58 years old. So that means there's going to be a lot of opportunity for people to get involved and actually start participating in this business. How would you like to get in front of that wealth transfer? One or more reason for financial services, there's a huge need in the marketplace. There's a high per sale compensation plan. There's a lot of money in this deal. It's a replacement product, so people don't have to take more money out of their current budgets in order to cover the cost of what they're doing. It's not like a lotion, potion, pill, or juice. You can actually replace people's products with things that they need and things that they're currently buying, creating a residual income money mailbox for you and your family. So let's take a look at who needs solutions in their lives. People always talk about the baby boomers, and of course there's 77 million of those people between the age of 50 and 64, and of course they need solutions. Most of them are looking for second incomes or trying to recover wealth. Perhaps over the last 5-6 years, things have not treated them well as far as the stock markets and the retirement vehicles have done, so they're looking for coverage there. They're also looking for permanent insurance, some kind of financial vehicle that's going to help them to be able to provide for their family in the case of an untimely death. So we have products to help them in those situations, to help them move forward and be able to start accomplishing their goals once more. Now, of course, you have that older generation, the seniors, those over 65, and that's over 40 million people. And, of course, they're looking for a lot of the same things. Right now, more seniors are going back to work than ever before. I say people are looking for lifetime income. They're over 65. They're starting to look at retirement and Social Security and realizing it's just not enough. And, of course, they're looking for survivorship life insurance. They want something there that's going to help their spouse and then, of course, provide for their children in the case both of them do pass away. And, of course, the QS2 opportunity provides for that as well. Of course, you also have the Generation Y, those ages 20 to 34, and Generation X, the ages 35 to 49. Everyone needs additional coverage, whether you're starting a new career, a new business, a new opportunity. People are looking for ways to create more income, to accumulate more wealth, and they need to protect what they've got. They need to provide for their families. So why financial services? Because everyone needs it. Over 200 million people are looking for some kind of benefit that we could provide in the financial services industry. Now, QS2 as a financial services company is learning from the past to perfect the future. What do we mean by that? In 1977, you may have heard of A.L. Williams. They started up with the idea of buying term and investing the difference. Now, that made a lot of sense, and people bought into that idea. Well, why? Because they had large families, they needed large coverage, and prior to this time most people bought whole life policies which had high premiums and low coverage, whereas term policies gave you high coverage with low premiums. And so A.L. Williams, by teaching people to buy term and invest the difference, became the #1 term life producer in the country. They developed 750,000 agents over 14 years and paid out over $1 billion in commissions. In 1991 they sold to Citigroup, and they put them into and they're now doing business under Primerica. So what's the problem with that idea of buying term and investing the difference? Sometimes the customers just didn't invest the difference. And what happened is 10, 20 years later, when those term policies ended, they had nothing for the investment they had put in because all they had was rented insurance. So what happened is some of those people in 1991, when A.L. Williams was sold and became Primerica, some of those people started their own company called WMA. They looked at what A.L. Williams did right, and they tried to improve on it. So what they did is they created a variable universal life program where you're able to put your market, or you put your investments in your insurance product into the stock market so you can keep up with inflation. It made a lot of sense at the time. The stock market was growing very rapidly, and people's VULs, or variable universal life policies, were growing quite well. WMA over the next 10 years became the #1 producer over VUL, insurance producer. They've developed 250,000 agents, and they too also paid out $1 billion in commissions. The problem with that, though, sometimes the stock market goes down. So when it did go down, which it did about 5 years ago in 2008, many people saw their portfolios drop in half and sometimes even more. How many people do you know that said that their 401ks became 201ks? We heard that over and over again. The same thing happens here. When your money's at risk in the stock market and the stock market goes down, your retirement is at risk. Now, we offer both licensed and non-licensed products. So on the licensed side, we offer life insurance, annuities, CDs, market annuities, second market annuities, senior products, as well as property and casualty. For those that have a large investment portfolio they want to see invested, we don't actually do that for you, but we do have a registered investment advisor, an RIA, where we get professionals that actually can work with you. These guys normally only work with portfolios of $10 million or more, but they'll work with our people because we bring together a large group there. And if you know some small business people that are looking for a 401k platform to provide for themselves and their employees, we even offer that type of option. When it comes to non-licensed products, we also offer some lead generation products. So just by introducing people that need a CD or want these second market annuities or medical insurance, you can actually receive a commission for developing that lead. We have something called land banking, where you're able to buy a piece of property in a developing area, buy it and put it in your IRA, so you can actually purchase it right inside your IRA, so it'll be tax deferred as far as the income goes. Now, with the company we're working with land banking, they've been averaging a 24% average rate of return for the last 17 years. 24%. Now think about what that means. If you take the rule of 72, and some of you might remember that from school, this is something Albert Einstein came up with. You take the interest rate divided into 72, and it gives you how many years it takes for your money to double. If you're getting a 24% return in land banking, that means every 3 years, 24 divided into 72 gives you 3. Every 3 years, your value is going to double. So if you bought a $100 piece of property, in 3 years, that property is going to be worth $200,000. You can sell it at that point, capture those gains, and leave them right there in your IRA so it continues to grow tax deferred. We also have some medical debt management programs, prescription plan programs, as well as credit repair. So there's a lot of opportunities to be making money even before you get licensed. But of course, we want everyone to become licensed to help market some of these insurance products. Now, I know we've been talking a little bit about insurance, and some people are actually thinking like Woody Allen here. There are worse things in life than death. Have you ever spent an evening with an insurance salesman? And we just laugh at that, of course. We've all had that experience, maybe the Groundhog Day experience where we talk about the life insurance salesman, how pushy and how funny he is. The reality is it's a serious situation, and we can do this professionally without having to embarrass ourselves. So let's talk about some of the carriers that we offer. We work with 100 of the top life insurance companies in the country, as well as 25 of the top property and casualty insurance companies in the company. These are companies that you might recognize. These are all nationwide companies, all A-rated or above companies, people that you can do business with and be very secure in knowing that your financial future is being protected there. Let's talk about property and casualty for just a minute. How many of you have property and casualty insurance? Well, everybody should. Of course, auto insurance is required by law. If you have a home, you should have homeowners insurance. If you're renting, you should have renter's insurance. If you have a small business, you're going to have some kind of liability insurance to help protect your business. And most of us might have called on a State Farm, an Allstate, or a farmer's agent. These are some of those captive agencies to get that benefit, that protection that you're looking for. What if instead we can save you 20 to 30% on your property and casualty insurance simply by switching it to an independent company. And if you look at this list, you'll recognize some of these names: Travelers, Progressive, Hartford, MetLife. These are guys that you've heard about before. These are huge companies, multi-billion-dollar companies that provide the exact same type of coverage at usually 20 to 30% less than those captive companies. So what are we recommending? Move from one to the other. Move from the place where you're at right now with the captive insurance and join up with another independent company. It's as simple as that. Switch simply by switching, you're going to save 20 to 30%, and you're going to be able to get the exact same coverage. We're going to be able to meet or beat your coverage that you currently have. Now let me also tell you about another product we have, QS2 Total Protection Plus. Now we've talked about term insurance before. This particular policy actually includes term life insurance, so you can get some high values for low premium amounts, but it also adds to it a critical illness function. So if something were to happen, let's suppose that you get cancer or some serious disease or illness that causes you to be disabled and have to worry about huge medical bills, it's going to pay you up to $50,000. That's right, an additional $50,000 above and beyond what your health care costs, so that you can use that to help cover those additional expenses and lost earnings. In addition, there's a disability function into it that's going to pay you $2,500 a month. So you've got the additional benefit there that's going to help with those those things that continue to happen in your life where you need some additional coverage. All of this is covered with the return of premium. Now, if you think about that, what does that mean? Well, everyone knows term life insurance is basically renting insurance. You're using your insurance policy in order to help make sure that you're covered just in case something were to happen prematurely and you were to pass away, to protect your family. But you also know that at the end of the term, whether it's a 5, 10, 20-year life term policy, at the end of that term, your money disappears as well as your insurance. With this program, at the end of that time, you get your money back. So let me show you how that's going to work. Let's suppose that you went ahead and got yourself the life insurance protection you need. Let's say it was 20 years at $250 a month or $3,000 per year. Let's suppose that you didn't use that, you didn't pass away, you actually survived it, and after 20 years, that $60,000 in premiums that you had paid gets returned back to you. Now that's kind of a nice bonus. If you're 40 years old today, imagine that 60 receiving a nice $60,000 return of premium payment that you can use to do whatever you want. Buy additional life insurance, buy a boat, take a vacation. It's up to you. The money is yours. Congratulations for not dying. So let's talk a little bit about risk. How much of your money are you willing to put into harm's way? Most people don't want to put any of their money in harm's way. However, today 90 to 95% of most people's money is already in harm's way. Think about it. Do you have your money tied up in stocks, bonds, mutual funds? If you do, you're at risk of having the stock market switch, go bad, go negative, go down, whatever you want to call it, and you're going to start getting the pains of what that's going to do to your portfolio. If it happens just before you retire, like it did to many of my friends 5 years ago, you could be put in a situation where retirement is no longer a reasonable option. So let me tell you about another concept called indexing. This is something you may or may not have heard about. It allows you to participate in the gains of the stock market while eliminating the losses. That's right, we can eliminate the losses that the stock market returns. Now let's look at the last 12 years. This is year 2000, 2011, where we can look at the Standard & Poor's Index for the last 12 years. Now in year 2000, you notice it was at 19%, 2004, 26%. It had some good return years there. And people that were in the stock market at that time, when they talked about returns, they were talking about these double-digit returns that they're seeing. Now let's suppose that you had a product like we're talking about with indexing. There's going to be a cap. Now what that means is they're going to lock out you're allowed to participate in the gains, but you're not going to get all of the gains. In this particular example, we're going to show a 12% cap. It could just as easily be 14 or even 16%. So in the year 2000, when the S&P was returning 19%, you only got 12%. Now you may be thinking to yourself, wait a minute, what about that other 7.5%? And in 2004, it was really obvious. In 2005 and 6, basically because it was less than 12%, you got the entire stock market gain. So you start looking, you go, do I really want indexing? Because look at how much money I'm missing out there. Remember, this system is designed to participate in the gain, so you're still able to capitalize on a lot of the gain, but you're eliminating losses. And so that's costing you a little bit on the high end, but on the downside, let's take a look at what that means. In 2001, 2, and 3, the stock market actually had negative returns, double-digit negative returns. As I say, in 2008 or 2009, you had the exact same thing, double-digit. Stock market lost 40%, almost 40%. Now, what if instead of you taking those losses, you're able to maintain your portfolio? Instead of getting a loss, you got a zero gain. So you're able to keep your entire portfolio. Now let's take a look at how that works out as far as real world and why the benefit of that type of a program. So if you take a look at this chart, you'll see we're charting the $100,000. Let's say that you put $100,000 into your program and you started out in the year 2000. Now following that line, you see that yellow line, that we had those immediate 3 years of negative returns. So your investment into your retirement package started losing value. It went from $100,000 to about $120,000 with that 19% return the first year, but dropping 10, 13, and then 23% gives you an cumulative loss down under $75,000. Well, you start to grow it back up over a few years, and then pow, you get hit with it again. The stock market is unpredictable. There is a risk involved, and you just need to be aware of that and be willing to take that risk. But what if instead of taking those losses, you were able to take a zero instead? And so you see what happened. You don't have to start over again at the lower amount. You're able to stay even. And when the stock market starts to go up, so does your value of your portfolio. Look at the difference at the end of those 12 years. At the end of 12 years, after worrying about it, stressing about it, sleepless nights, watching the stock market go up and down and wondering what your return was going to be, if you're just in the S&P 500, at the end of 12 years, your $100,000 investment turned into $102,000. All that stress for $2,000 worth of return. Or with an index product, because you're not taking the losses, you actually doubled your return to $204,000. Now you can see the power of indexing and why we're such a believer in the idea of indexing. Participate in the gains, protect yourself from the losses. If you don't lose any money, you're always going to be able to get further ahead and have a better portfolio. So with QS2, we're going to find a custom fit for you. Whether you're young, just getting started into the marketplace, starting to build your own life, your own future, you want to start accumulating some money, we can do that. We can show you how to accumulate in smart ways so that you're protected in the future. If you've already started to build a future, you've got a family, you've got a business, we can help you and to preserve what you've got as we continue to grow it safely and protect it as well. Of course, as you start getting older, it's about distribution. If you're able to survive and you're not passed away, don't you want that money to be there for you? That's the idea of health insurance, or I should say life insurance for life. It's for the living. It's not for those that have passed away. It's for you to live on and to enjoy and to be blessed with. So let's talk about each of those things as we go forward as well. First of all, I want to talk about the value of starting early. This graph is going to show you that if you invested $5,000 a year for 10 years, that's all you did with no additional contributions, this graph assumes an 11% annual return. So let's look at the young investor at age 25. Starts to invest that $5,000 a year from 25 to age 30 for 10 years, puts in $50,000, and at the end of his working life, when he hits 65 and he wants to retire, he's got an investment of $787,000. Now let's take a look at investor B. Let's suppose that she decides she's not going to get started investing until she can afford it, until she's 35. And so at 35 years old, she starts to invest the same $5,000 a year for 10 years. And at the age of 65, when she's ready to retire, her investment portfolio is half at $364,000. By starting 10 years later, waiting till she can afford it, so to speak, she's actually lost half of her investment power. Now let's look at investor C. Maybe they waited really long. Maybe this guy decided he just couldn't afford it at all. And at 45 realized how close retirement was for themselves and realized they needed to start making a change. By investing the same $5,000, the same $50,000 over 10 years, his portfolio turns out to be only $168,000. And of course, investor D, it's even sadder because they've got no time for that money to continue to grow and to double and to increase and to give them the return. Starting early, you can never start too early. It's the best in practice for your financial future. Now, as we start looking at plans, as we start looking at vehicles to help you get there, we want to try and find the perfect plan, the perfect insurance product to help you get there. So we're looking for three major concerns for most people. How do we protect your money? How do we accumulate enough and keep it growing? What about health? What if you got sick, if you had a major illness? How are you going to survive financially and emotionally in that situation? And what if you do pass away? You want to leave a legacy so that your loved ones are able to endure those financial hardships after you're gone. We're looking to secure yourself to make sure that those things are in place. There are 5 key features that are going to have to be included to make the right plan. These 5 features include a significant tax-free benefit. That way, if you do pass away, your spouse or family member is going to receive that benefit tax-free, so they're able to enjoy that financial security that you're providing. The second thing is the ability to access needs in case you have any kind of chronic or terminal illness, regardless of your age. So what if it's 40 or 50 years old and you need to access this money? We want to make sure you can do this. The third thing is a guaranteed vehicle that will allow one to build a tax-free retirement. It's not going to have any loss of principal. So there's no loss of principal or previous earnings in a down market, but you're able to participate in the gains during an up market. If you think about that, that's what we were talking about with indexing a few minutes ago. And the option to continue the plan in the event of a disability. What if you do become disabled? Don't you want the additional coverage and additional help to make sure that that plan stays in place for your family if you lose your income because of a disability? And fifth, it has to be easily understood, offer total safety, and be affordable. We're going to talk about Index Universal Life, as QS2 offers it. This plan is all of those things. Indexing, again, means that you get to participate in the market's growth with no downside risk. You get additional term life insurance to help cover it in case you do pass away sooner. You also get tax-deferred growth. Tax-free withdrawal at any age. That means you don't have to wait till retirement in order to start pulling the money out. And you can withdraw it for any reason without any penalties. That's kind of nice. If you want to return at 40, 50, 60 years old instead of waiting for 60, 70, 80 years old, you can do that. So let's take a look at this plan that we're talking about. Let's say our client is Robert. He's 40 years old. He wants to get some additional coverage. He's funding his IUL, Index Universal Life Plan, at $300 a month for 25 years. So his total out-of-pocket funding for the 25 years, $90,000. This is going to provide for him just $100,000 with the death benefit, but let me show you what it does as far as a living benefit goes. So at the age of 66, he decides he wants to retire, and he starts taking tax-free distribution. That's $25,000 a year, $25,439 a year. Now this can be used for any purpose. Of course, if he needs medical expenses or long-term care, it can be there to help with that. If he just wants some additional lifestyle for him and his family, he could do that as well. Tax-free distribution start at 25 years old, or at 66 years old. The other benefit here is if they're on Social Security, which at this point could easily be, this is not taxable income that would go against Social Security, so you're not getting double tax on your Social Security benefits as well. So let's say that Robert decided to take the tax-free distributions over 20 years, took a total of $508,000 over that 20 years. Remember, he's only put in $90,000. Now he's taken out $500,000 and still has a remaining death benefit of $132,000, which would go to his heirs tax-free as well. Doesn't this type of a plan make more sense? That's why we talk about Index Universal Life. Now let's suppose Robert decided to forego early distribution and instead had a death benefit at the age of 86 of over $1 million going tax-free to his family. That's what could be done, again, in an Index Universal Life. It puts you in charge. Whether you want early distribution or whether you want to leave it all in there and let it continue to grow, it's up to you. Now let's talk about QS2's compensation plan, because many of us are here tonight trying to figure out how we can make additional income. Our compensation plan, let's assume that we're using a $10,000 premium allowance. The nice thing in this industry, financial services, insurance, is the commissions tend to be very, very high. What I'm talking about is if you agree to pay $2,000 or $3,000 a year for a life insurance policy, chances are that's what the commissionable amount is going to be to the agent, $2,000 or $3,000, or at least to the compensation pool. So we're going to assume that the $10,000 in premium that you wrote for those insurance policies, and maybe it's 3 or 4 different people paying a couple $100 each, goes all $10,000 of it's going to the compensation pool, or to the grid as we call it. Now the company is going to throw in an additional $500 or an additional 5% bonus that gets paid to generational overrides. So you're going to have $10,500 for that $10,000 worth of business that you did, or 105% total compensation. So what do you receive as far as base compensation from that $10,000 target? As a new associate, you're going to get paid 50% of that money. So you're going to make $5,000 on those sales. Think about that. When's the last time with just a few sales, maybe it's 4 or 5 sales to generate the $10,000 in annual premium? Remember, it's annual premium. I say, when was the last time that you were able to generate $5,000 with just 4 or 5 sales? This time you're going to be able to do it with things that people need. Now you notice in order to move up as an associate, you do need to do 5 training sales. And the way that works is you're going to go out with an experienced professional. They're going to help you make those sales presentations. They're going to help your family members and friends and those people that you introduce them to understand exactly what their opportunity is here as far as protection goes, as far as life insurance goes, as far as retirement benefits go, so that they can get them in the right products at the right price point. For doing that, normally as a licensed agent, you're going to share half of your commission. So instead of making 50% or $5,000, you'd be making $2,500 at that level. Once you've done your 5 training sales, you can go off and do your own sales by yourself. Many of our associates find that it's more beneficial for them and for those that they talk to continue to do additional training sales to get some additional training. And to spend 50% of your bonus in order to do that sometimes is worth it. I say, if you think about it, when you go out and you talk to your friend or your family member and they decide, hey, I want to get a life insurance policy, maybe they ask for a $50,000 or $100,000 policy. But if you had done a little bit more research, a little bit more time with them, a little bit more investigation, asking a few more questions, you'd find out that they really needed $1 million or $2 million worth of coverage. That's what a senior agent's going to be able to help you with. An experienced agent's going to be able to help you get the right coverage, and that's going to generate more commissions. So I find frequently, simply by sharing the commissions with a senior agent, you're actually making more commissions, even though you're sharing those commissions. Now, as you continue to grow, I want you to understand that the industry typically only pays 30 to 40%. So 50% is a good commission structure. And as you continue to grow, you're going to continue to advance into our more advanced levels, where you're going to continue to grow your commission. So instead of getting 50%, it can grow to 55, 60, even 65% as you continue to build your business and develop your own experience in this industry. The other nice thing, as you hit our executive levels, these last levels in the yellow, you actually start to qualify for generational overrides. And we're going to talk a little bit about how that works. Basically, for the people that you introduce to the program, you're going to receive an override on all of the business that they write. So on the first generation, the people that you personally introduce, you're going to receive 8% of the business that they create as they build their businesses. On the second generation, it goes down to 6, and then 4, 3, and 3%. Now this is beautiful, because what this allows you to do is allows you to get paid on the efforts of the people that you introduce to the program, as well as the people they introduce, and they introduce, so on and so on and so on. Now I'm showing down through 6 generations. Now the competitors out there, the people that you're going to be, that have already been in the market, the ones we've talked about previously, they pay down through 6 generations, and they're not paying 3% on the 5th and 6th generations. They're paying a fraction of that. So with QS2, they decided they want to create a compensation plan built for the builders, built for leaders who really want to grow and go and make something happen here. And so what they've done is they've actually introduced 4 more levels of leadership generational overrides at 3% each. So you're going to receive 3% on the 7th, 8th, 9th, and 10th level. This could equal tens of thousands of dollars as your group starts to grow. Imagine you might have a few hundred or a few thousand people on your team, and you're going to receive generational overrides on each and every one of them. So let's talk about getting started today, our basic training program. It's going to be basically build your own plan, complete a financial needs analysis, figure out what it is that you need for your own family to protect your family in case you die early, or you become disabled, or have a catastrophic or critical illness, or just wants to look at retirement in the future. Using your own products, we're frequently able to trade the products that you're currently paying for and get you into less expensive but more comprehensive coverage at no additional cost out of pocket. Or if you need to add a few more things, let's make sure you're getting the very best products for you and your family at the best price. Remember, as independent agents, we're able to bid out against 100 different companies so that we're able to get you the very best pricing for your particular situation. And then start creating a list of people you know. Who use insurance products? Well, the answer, of course, is everybody. So we want you to introduce QS2 services to those people on your list. You're going to complete 5 field training sales with an upline or a senior agent so that you can get that experience working for you. Now you may find that 5 is you'd rather do 10 or 15 or even 20 sales, and that's okay too. And let me show you how that's going to work. Let's suppose that you're not currently licensed, and you go out and you do your 5 field training sales. And it takes you about a month to get those done. Some people will do it in the first week. Some people might do it in the first day or two. Other people will do it in a few weeks, and that's okay. Let's suppose it takes you a month, and during that month you're getting yourself licensed, you're getting yourself prepared to take the correct tests. So you've done 5 field training sales. That's a total of $10,000 worth of commission. Remember, we talked about $10,000 before. Now remember, you're going to earn a 50% commission, or $5,000, and then you're going to share that with your trainer. So you would have taken $2,500 home had you already been licensed when you got started. In this situation, you're going to get reimbursed from your field trainer for expenses that you've incurred, including the time and effort in order for you to get licensed. And you're going to receive $2,500 for that time and effort if you did something like this, 5 field training sales for about $10,000 worth of policy. So you would have earned basically the same amount of money as you got yourself started, without having to go out and do all those sales yourself, which you wouldn't be allowed to do if you're not a trained or a licensed agent. The nice other benefit here is you're actually able to advance forward one more level. So you're not starting out as an associate at 50% anymore. Now you're starting out at 52.5%. So you're going to make more on every policy that you write. Let's suppose that you went out and had your field trainer help you make 10 sales, maybe 15 or 20. Notice that your reimbursement from the field trainer jumps to $5,000, $7,500, and $10,000. But more importantly, take a look at your quick start promotion level. You've gone now from an associate to a senior VP, making 60% on all of the business that you do. And you've done that in the same 30 days it took you to get licensed. You've earned a reimbursement of the same type of money that you might have earned had you been licensed. So don't wait to get licensed. Get out there, start doing training sales, start getting in the field, start watching a senior experienced agent do the business, and do it with your friends and family so that you can actually see how it's done. You can start seeing some strategies and some ways to build the business as well. Now, once you've got yourself all positioned, you're all licensed, and maybe at this point you become a senior VP because you went ahead and did 20 training sales with your training field trainer. Let's talk about what's going to happen for you from there. This is the value of one person. So the next person that you bring in, you recruit your new associate, John. You're at the SVP level, remember, at 60%. So you're going to do a financial needs analysis with John, find out that he really needs about $250 a month worth of coverage. Now, this is a combined coverage. This is his property and casualty insurance. This is his life insurance. This is his retirement package. This is everything. And let's say that he needs $3,000 a year, $250 a month. Your commission at 60% of that is going to be $1,800 in commissions. Where else can you generate those kind of commissions with a single sale? By bringing in a new associate. But remember, John, he needs to go out and recruit and do 5 training sales as he gets started so that he can advance forward. So he goes out and he brings on his first person, and you go with him to help do the financial needs analysis, to help them understand the products that they need. Let's say that they have a similar situation where they need $3,000 worth of coverage each year, $250 a month in that field training sales. Now again, these are just examples. We're going to use that same number over and over again so that we can keep the math simple. Now you have a 35% average spread. What does that mean? Remember, John, he's the new guy at 50%. He's going to share half of his sale with you, so 25 each. So you're going to get 25% of that plus the 10%, the difference between 50 and 60% coming to you. So you're at 60%, he's at 25%. The difference is a 35% spread, which means $1,050 coming to you by helping John make his first sale. You help him do his second, his third, his fourth, and his fifth sale. Each of them basically doing the same thing, or $1,000 in additional compensation to you, which is $5,250 in overrides for that spread, gives you a total of $7,000. And if it only took you a month to help John go out and get his 5 training sales in place, you've just made $7,000 that month working with one new associate. Well, let's take it to the next level. Let's suppose that you start building it up. Remember, you're going to go out and you're going to help some families yourself, so you're going to do some personal sales. Maybe you're going to help 4 or 5 families a month, each personally, generating the same type of volume, $250 a month, $3,000 a year. It pays you $9,000 a month in personal sales, just helping 5 families protect themselves. Let's now help those new associates that you brought in do 5 total field training sales. Now, we're not talking about 5 sales each. We're just talking 5 total field training sales, with whether it's 1, 2, 3, 5 different associates, 1 each, or whether it's 1 associate doing 5, it doesn't matter. You're going to make an additional $5,250 a month. So what does that mean? your monthly income just by doing 5 sales yourself and helping with 5 training sales is going to be $14,250 a month. That's right. With just a few associates working with you, you can be making almost over $14,000 a month, or a total of $171,000 a year with just a few. Now let's suppose that you grew a little bit bigger. You made it up to the vice chairman level. Your commissions for your personal volume are going to go up because remember now you've gone from 60% to 65%. Helping those few training sales, you're going to go a little bit up as well. So now we're at $6,000 a month just on those 2 activities. But now you started to build a team. Let's suppose you build a team of 30 associates that are each helping 2 families a month, just 2, and the average spread is 5%. That means that maybe some of them are senior VPs making 60%, you're at the vice chairman level making 65%. They may actually be on lower levels. They might be new associates as well, making only 50%. That spread would be higher. But let's assume that those 30 associates on your team are helping 2 families a month. You're making a $9,000 a month override on what they or spread on what they're doing. Now, in addition to that, you're also going to kick into generational overrides and to help the same 30 associates helping 2 families a month is at a 4% generational override. Remember, we talked it goes from anywhere from 3% to 8%. We're going to use 4% for our example here. Is going to pay you $7,200 additional per month. So with a small team of just 30 people on your team, helping 2 families a month, your income has jumped to $31,950 just per month. $31,000 a month. Take a look at that. That's almost $400,000 a year. And all you're doing is having a team of just 30 people to help you get there. You ready to take it up one more level? Let's do that. So let's take a look at, let's say that you build a team, and in the first year you recruit 1,000 people. Now this isn't you personally. This is you and your whole organization recruiting 1,000 people. And suppose that you recruit 1,000 people, you started working them through the process. Now, industry statistics show that only 11% of those people that get into the insurance industry are still here a year from now. So they have enough success that they decide that they want to work as full-time agents and start building a business. So let's suppose it took you a year to put in 1,000 people on your total team, and only 110 of them stuck. They stayed here and did business. And let's suppose that each of those are doing 1 case a week, 4 cases a month, at that same level we talked about before, $250 a month, about $3,000 worth of annual target premium. Your income from just those 110 associates is over $200,000 per month. That's just in those overrides, those bonuses, that spread that we had talked about earlier. Can you see why we did financial services? There's a lot of money in financial services with a very small team. Here we're talking about a team of 110 full-time agents doing just 1 deal a month. So we're not talking about anything crazy here. You're making $200,000 a month in overrides and commissions. Now let's suppose that year 2 you went out and recruited another 1,000 people. Year 3 the same, and you had the same type of success. Your income can grow exponentially to where it's making hundreds of thousands of dollars a month, even $1 million a month. Where else does this type and this magnitude of opportunity exist in the network marketing industry? Only in financial services. Take a look at it, set up your 5-year plan, think about what you can do and how big you can grow it. If you've ever built a network marketing business before, or you know anyone that has, bringing in 1,000 new recruits on a team is not an impossibility. It's actually something that's done quite regularly, and it can be done in a very simple process for you so that you can have the success that you're looking for. One of the nice things about QS2 is they actually offer an associate's bill of rights. Remember, we're in the financial services industry. What this means is that these insurance policies, these different benefit plans that you're putting together for your customers, these things are things that are going to continue to pay you year after year after year. Now, the second year commission is not as big as the first year commission. In fact, it's about 10%. But imagine owning those ongoing commissions. QS2 offers you the following bill of rights: a written promise to our associates that you will be able to own that business. So that way, if you decide you want to sell it down the road, it's your book of business that you can sell and capture all that cash. Or if you want to retire and receive ongoing commissions or pass that business on to your beneficiaries, all of those opportunities are available to you as well. Something else that QS2 offers is they actually offer equity ownership. That's right. As you become a QS2 associate, the company has set aside 30% of its equity for those people that help build the business at the beginning. And you're here at the beginning. You can actually earn ownership in the company. And as this company continues to grow and becomes a billion or a multi-billion-dollar corporation, you can actually have tens of millions of dollars worth of stock ownership that you've earned simply by doing your business. QS2 is restoring the dream of prosperity and financial independence. You can earn more money, you can protect your assets and secure your future. Now, one of the other nice things about the financial service industry is they offer a lot of contests and bonuses. These are coming directly from the insurance carriers, the people that we work with. And those people will actually offer you trips, cars, and cash just for doing business with them. So there's an opportunity for you to take a lot of vacations, a lot of trips, have cars paid for by the insurance carriers that you write business with, and have additional cash bonuses. QS2 is actually offering their own trip, their own celebration to paradise. We're going to be taking off to Hawaii in the spring, and those people that build a business now will be traveling with us. Join us as we continue to grow and to go and to enjoy the opportunities that come for a lifetime. You'd remember the millionaire mindset guy, T. Harv Eker? I say this is what he said. The number one reason most people don't get what they want is they don't know what they want. Do you know what you want? Have you started to establish a goal and a dream and a platform that's going to help you get where you want to go? Now's the time to do something. It's going to take some effort. If you're willing to only do what's easy in life, then life's going to be hard. But if you're willing to do what's hard, life can be very easy. Step up a little bit. Step outside your comfort zone. Do those things today that are going to help you to grow and to build a business that's going to last for you and for your family for generations on generations. So how do you get started today? Well, we're going to get you started right away by helping you either become an associate, where you can make some more money either full-time or part-time, become a client where we can help you get the right products for your family to secure your financial future for your family, or we can show you how to become a business owner where you can create wealth for yourself and for generations to come. It's as easy as getting back with the person that invited you here today. Get signed up as a QS2 associate. Let them know what your goals are. Plan your dream, achieve your goals, and restore the dream of financial independence for you and your family. Thank you for taking the time to listen in this day. I appreciate you all being here. I wish you much success as I see you in the future as we restore the dream of prosperity and financial independence. This is Mike Murano. It's been my pleasure.